September 1999, the last days of Lucent Technologies' fiscal fourth quarter. Account teams across the company were working to close equipment orders before the September 30th cutoff, and among the buyers were competitive local exchange carriers, startup telecom operators that in many cases had been incorporated within the prior 18 months and carried no meaningful operating cash flow. A telecommunications switch sold to one of these carriers was booked as revenue at the moment the purchase agreement was signed. The obligation to pay for that switch, in the many cases where Lucent had financed the purchase itself, was recorded as a receivable and carried forward as an asset on the balance sheet. The structural question this episode answers is how a company recognizes revenue on a sale it has financed with its own money to a customer whose ability to repay depends on business conditions the seller cannot control, and how that arrangement remains invisible to the market until it is not. The mechanism at the center of the Lucent case is vendor financing. The term is precise, and the practice in itself is entirely legitimate. Vendor financing describes an arrangement in which the seller of a product extends credit to the buyer to fund the purchase of that product. The seller either lends the buyer the money directly or guarantees a third-party loan. The buyer takes delivery of the equipment, owes the seller for it, and pays over time. In capital-intensive industries, this is ordinary. Equipment manufacturers routinely finance their customers because the equipment is expensive, the customers are often expanding, and the financing itself can be a source of interest income and a competitive tool to win business against rivals who will not extend the same terms. Consider the legitimate baseline. A telecommunications equipment vendor sells a switching system to an established carrier. The carrier has existing subscribers, existing revenue, and a track record of paying its obligations. The vendor extends payment terms or arranges financing because the carrier's creditworthiness is established and the risk of non-payment is quantifiable. The vendor books revenue when the criteria for revenue recognition are met. Persuasive evidence of an arrangement, delivery, a fixed or determinable price, and reasonable assurance of collectability. That last criterion is the one that governs everything. Revenue recognition is not permitted where collection is not reasonably assured. The receivable is an asset only to the extent that it is expected to be collected. Where collection is doubtful, the receivable must be reserved against, and where the sale itself depends on financing the vendor knows will likely not be repaid, the question becomes whether a sale has economically occurred at all. Now introduce the distortion. In the late 1990s, the telecommunications sector was in the middle of a capital expansion driven by deregulation and the expectation of explosive data traffic growth. The Telecommunications Act of 1996 had created a new class of buyers, competitive local exchange carriers, or CLECs, entrants intended to compete with the incumbent local phone monopolies. These entrants were, by definition, new. Many had no subscribers yet. Many had no revenue yet. They existed on venture capital and on the expectation that they would build networks, acquire customers, and generate cash flow later. To build those networks, they needed equipment. To buy that equipment, they needed money. And the equipment vendors, competing fiercely for a finite number of these buyers, offered to supply both the equipment and the money. This is where vendor financing crosses from a legitimate tool into a revenue generation mechanism with a structural defect. When a vendor finances a customer that has no independent means of repayment, the vendor is not merely selling equipment, it is, in economic substance, funding its own revenue. The cash that appears to flow from customer to vendor originated with the vendor. The receivable recorded as an asset is only collectible if the customer's future business succeeds. And the revenue recognized at the point of sale reflects a transaction whose completion is contingent on events that have not yet happened and may never happen. The structural device, then, is not the financing itself. It is the recognition of revenue on finance sales where collectability was not reasonably assured, combined with the treatment of the resulting receivables as sound assets, rather than as contingent claims against enterprises that did not yet generate cash. When a company does this at scale, it can manufacture the appearance of demand. Each quarter's revenue grows because the company lends the money that funds the purchases that become the revenue. The loop is closed, and a closed loop, by construction, can continue only as long as the lender is willing and able to keep supplying the capital that drives it. The Securities and Exchange Commission's enforcement record against Lucent, resolved through a settled administrative proceeding, establishes the specific conduct at issue. The record shows that Lucent improperly recognized revenue and violated the anti-fraud, reporting, books and records, and internal control provisions of the federal securities laws across fiscal year 2000. The vendor financing exposure was one element of a broader pattern of revenue recognition failures, and it is the element that most cleanly demonstrates the mechanism. Let us build the architecture step by step, because the structure is what matters. Step 1. The buyer profile. The customers at the center of the vendor financing exposure were, in substantial part, emerging carriers. According to the public record of the period, Lucent's total customer financing commitments grew dramatically as the telecom capital cycle accelerated, reaching billions of dollars in commitments extended to service providers, a significant portion of them to new and financially unproven entrants. The critical structural fact is the mismatch between the buyer's capacity to pay and the timing of revenue recognition. The buyer's capacity to pay lay in the future, contingent on network build-out and subscriber acquisition. The revenue recognition occurred in the present, at signing and delivery. Step 2. The financing commitment. Lucent extended credit to these buyers in one of two forms. It lent directly, recording a note or account receivable, or it committed to fund future purchases under a facility, creating an obligation to supply capital that the buyer would then use to purchase Lucent equipment. In both cases, the source of the buyer's purchasing power was Lucent's own balance sheet. This is the defining feature of the loop. The vendor is simultaneously the source of the customer's funds and the recipient of those funds as revenue. Step 3. The revenue recognition. When equipment was shipped to a financed customer, Lucent recorded the sale as revenue. Under the applicable accounting rules of the period, revenue could be recognized only if collectability was reasonably assured. The structural problem is that when the customer's only source of repayment is future business success, and when the vendor itself is funding the purchase, the assurance of collection is not a function of the customer's present financial condition. It is a bet on the customer's future. Recognizing full revenue on such a transaction treats a contingent, future-dependent outcome as a completed, present exchange. Step 4. The receivable as asset. The unpaid balances owed by finance customers were carried as receivables. A receivable is an asset only to the extent it will be collected. Where the customer is a pre-revenue startup dependent on continued capital markets access, the fair value of the receivable is not its face amount. It is its face amount discounted by the probability of collection, which for many of these buyers was materially below 1. Carrying these receivables at or near face value overstated the asset side of the balance sheet in the same motion that recognizing the revenue overstated the income statement. Step 5. The pressure that drove the timing. The cold open describes account teams racing to book orders before quarter end. This is not incidental. The SEC's findings across the fiscal 2000 conduct established that Lucent recognized revenue improperly on a series of transactions in order to meet internal and external revenue and earnings targets. The record includes specific transactions in which revenue was recognized despite the existence of side agreements, credits, and conditions that should have precluded recognition. The vendor financing exposure operated within this same pressure environment. When a company must show sequential quarterly growth, and when its most eager buyers cannot buy without being lent the money, the financing commitment becomes the lever that produces the reported growth. Step 6. The concealment of terms. The SEC's order in the broader Lucent matter describes transactions in which the true economic terms differed from the terms reflected in the accounting. Verbal side agreements, undisclosed credits, and arrangements that gave customers the right to return product or defer payment were, according to the findings, not properly reflected in the revenue recognized. In the vendor financing context, the structural analog is the gap between the nominal sale and the economic reality. Nominally, a switch was sold and revenue earned. Economically, Lucent had shipped equipment to a customer that would pay only if it could, using money Lucent had provided on a timeline that depended on a market that had not yet materialized. Assemble these steps and the org chart is simple. At the center is Lucent. From Lucent flows equipment to the CLEC. From Lucent also flows capital to the CLEC, either as a direct loan or as a financing commitment the CLEC draws upon. From the CLEC flows, in the near term, a purchase order and a signed agreement, which Lucent converts to recognized revenue and a booked receivable. What does not flow in the near term is cash from the CLEC to Lucent, because the CLEC has no cash. The cash is expected later, contingent on the KLSE's success. The loop is closed on paper and open in reality. The revenue is real in the accounting and provisional in economics. The scale magnified the fragility. As the telecom capital cycle peaked, Lucent's customer financing commitments expanded to serve a growing roster of buyers competing for the same anticipated data traffic. The larger the book of financed receivables, the greater the concentration of Lucent's reported growth in transactions whose ultimate value depended on a single macroeconomic assumption: that the capital markets would continue to fund the CLEC sector, and that the CLECs would build, sell, and generate the cash to repay. Every finance sale was a wager on that assumption. And the wagers were recorded not as wagers, but as completed sales and sound assets. This is the structural thesis. Vendor financing to non-credit-worthy buyers does not merely add risk to a company's balance sheet. It converts the company's own capital into the appearance of external demand. Revenue that should reflect the market's willingness to buy instead reflects the vendor's willingness to lend. And because the accounting records the transaction as complete, the distinction between demand and financing disappears from the financial statements. The market sees growth. The market does not see that the growth is being funded by the same entity reporting it. Now, the question of detection. Why did the gatekeepers not identify the problem earlier, and what would have had to be true for earlier detection to occur? Begin with the auditors. External auditors examine whether revenue recognition complies with the applicable standards, including the collectability criterion. The verification problem here is subtle. An auditor can confirm that a sale occurred, that equipment was shipped, and that a receivable was recorded. Assessing collectability, however, requires a judgment about the future financial condition of the buyer. When the buyer is an established carrier, that judgment is straightforward. When the buyer is a startup whose business plan projects positive cash flow years into the future, the judgment becomes a forecast, and forecasts about the telecom sector in 1999 and 2000 were uniformly optimistic. The verification chain fails at the point where a present tense accounting question, has collection been reasonably assured, is answered by a future tense industry forecast that everyone in the sector shared. For the auditors to have flagged the vendor financing revenue earlier, they would have had to substitute their own skeptical assessment of individual CLEC creditworthiness for the consensus view of the sector, and to do so transaction by transaction across a large and growing book of financed sales. That is a high bar. The applicable standards required reasonable assurance of collectability, and reasonable assurance was assessed against a backdrop in which capital continued to flow into the CLEC sector and defaults had not yet materialized at scale. The absence of realized defaults functioned structurally as evidence of collectability, even though the mechanism of the loop meant that defaults could only appear later when the financing stopped. Turn to the equity analysts. Sell-side analysts covering Lucent tracked revenue growth, order backlog, and earnings per share. The vendor financing disclosures existed in the financial statements as commitments and contingencies, but the reported revenue and earnings did not separate financed sales from unfinanced sales. An analyst reading the income statement saw revenue. To detect the loop, the analyst would have had to reconstruct the proportion of revenue attributable to finance customers, estimate the creditworthiness of those customers, and discount the reported revenue accordingly. This is precisely the analysis that a growth narrative discourages. When a stock is priced on the expectation of continued expansion, the analytical incentive runs toward validating the growth, not toward decomposing it into its financed and unfinanced components. The rating agencies occupied a related position. Their focus was Lucent's own creditworthiness, and the growing customer financing book was visible in the disclosures as an expanding exposure. But the agencies, like the analysts, were assessing that exposure against sector conditions that had not yet turned. A financing commitment that will be repaid is an asset. A financing commitment that will not be repaid is a loss waiting to be recognized. The difference between the two lies entirely in the future performance of the borrowers, and until that future arrived, the exposure appeared as manageable risk rather than as embedded loss. Now, the internal gatekeepers. The SEC's findings established that Lucent's internal controls over revenue recognition were deficient during the relevant period. The record describes revenue recognized despite side agreements and conditions that should have precluded it, which is direct evidence that the internal control environment did not reliably capture the true terms of transactions. When internal controls fail to surface the actual economic terms, the external verification chain has nothing sound to verify. The auditor confirms a receivable that the internal records present as clean. The analyst reads a revenue figure that the internal system has already validated. The failure propagates outward from the point of origin, and each subsequent gatekeeper inherits the distortion rather than correcting it. There is a deeper structural feature to the detection failure. The vendor financing loop generates evidence of its own soundness for as long as it operates. Each new finance sale adds to reported revenue. Each additional commitment supports additional purchases. As long as the capital continues to flow and the CLX sector continues to expand, the receivables are not yet impaired, the revenue is not yet reversed, and the loop looks like organic demand. Detection requires either a gatekeeper willing to declare that the future will not resemble the present, or the arrival of the future itself. In practice, it was the arrival of the future that ended the concealment, because no gatekeeper's incentives favoured declaring the collapse before it happened. For detection to have occurred earlier, three things would have had to be true simultaneously. First, the internal control environment would have had to accurately record the terms of finance transactions, including the contingent nature of collection. Second, the auditors would have had to assess collectibility on the basis of individual buyer creditworthiness rather than sector consensus. Third, an external gatekeeper, an analyst, or a rating agency would have had to isolate the financed portion of revenue and discount it for expected losses. Each of these was possible in principle. None was favoured by the incentive structure of a rising market. The record establishes the internal control failure directly. The other two failures are structural features of how growth sector companies are analysed. Now the unravelling. The trigger was macroeconomic, and it was not subtle. The assumption on which the entire vendor financing loop depended was that the capital markets would continue funding the CLSE sector and that the CLX would build, sell and repay. In the second half of 2000 and into 2001, that assumption failed. The telecom capital cycle reversed. The expected data traffic growth did not materialize on the projected timeline. Capital markets that had funded the CLEC sector withdrew, and the CLECs that depended on continued financing to reach cash flow positivity found that they could not. Trace the collapse through the mechanism. When the capital markets stopped funding the CLEC sector, the CLECs could not draw the additional capital they needed to complete their networks and acquire the subscribers whose future revenue was supposed to repay their equipment obligations. Their business plans, which had assumed continued financing, became unexecutable. Many entered financial distress. Some entered bankruptcy. As they did, the receivables Lucent had carried as assets became impaired. The face amount that had appeared collectible was revealed to be uncollectible because the buyers had never generated the cash to pay and now could not raise it. This is the point at which the loop, invisible while it operated, became visible in reverse. The revenue that had been recognized on finance sales had already flowed through the income statement in prior periods. The receivables that supported that revenue now had to be written down. A write-down of a receivable is the accounting acknowledgement that the asset is worth less than its recorded value, and by extension, that the revenue it once supported was not economically real. The company that had reported growth funded by its own lending now had to absorb the losses on that lending as the borrowers failed. Alongside the macroeconomic reversal, Lucent's specific accounting conduct came under scrutiny. The company announced revenue and earnings revisions. It disclosed that certain revenue had been recognized improperly and would be restated. The SEC opened an investigation into Lucent's revenue recognition practices. The public record establishes that Lucent revised its financial results for fiscal 2000, reversing revenue that had been improperly recognized. The reversal of previously recognized revenue is the mechanical proof that the original recognition was wrong. When revenue is reversed, the company is stating that the transaction it once recorded as a completed sale did not meet the criteria for recognition when it was booked. The SEC's enforcement action resolved the matter through a settled administrative proceeding. The findings established that Lucent had violated the anti-fraud, reporting books and records and internal control provisions of the federal securities laws by improperly recognizing revenue during fiscal 2000. The order described a range of transactions in which revenue was recognized despite side agreements, undisclosed credits, and conditions inconsistent with recognition. The company and certain individuals resolved the charges. Notably, the enforcement record also included a penalty component addressing the company's conduct during the investigation itself, which the Commission found had not met the standard of cooperation it expected. The specifics of that penalty are part of the public order. The unravelling of the vendor financing exposure specifically followed the arithmetic of the loop. As long as the vendor was lending and the borrowers were expected to succeed, the loop produced reported growth. When the lending had to stop, because the borrowers were failing and further lending would only deepen the losses, the growth that the lending had produced could not be sustained, and the assets the lending had created had to be marked down. The company's reported financial condition, which had reflected the loop while it operated, now had to reflect its collapse. The record shows the sequence with precision. The macroeconomic reversal removed the capital that funded the borrowers. The borrowers' distress impaired the receivables. The impairment forced write-downs. The scrutiny of revenue recognition forced restatements. The restatements confirmed that revenue had been recognized when it should not have been. The SEC's investigation and settled order established the securities law violations. Each step follows from the previous one, and each traces back to the original structural defect. Revenue recognized and receivables carried on finance sales to buyers whose ability to pay was contingent on a future that did not arrive. What does the Lucent case establish about the mechanism? It establishes, first, that vendor financing to non-credit-worthy buyers is not a financing decision layered on top of a sale. It is a transformation of the sale itself. When the seller supplies the capital that funds the purchase, the reported revenue no longer measures external demand. It measures the seller's willingness and capacity to lend. The financial statements record a sale, but the economic event is closer to a capital deployment with a contingent return. The collectability criterion in revenue recognition exists precisely to prevent this conflation, and the Lucent record demonstrates what happens when that criterion is satisfied by sector optimism rather than by buyer creditworthiness. It establishes, second, that a closed financing loop generates evidence of its own soundness for exactly as long as it operates, and no longer. The absence of defaults is not evidence that collection is assured when the mechanism guarantees that defaults can only appear after the lending stops. This is a structural property of the loop, not a failure of any individual gatekeeper's diligence. The verification chain was assessing a present tense question with a future tense forecast, and the forecast held until it did not. It establishes, third, that the arithmetic of the loop is symmetric. The same mechanism that produces reported growth on the way up produces impairment and reversal on the way down. Revenue recognized on finance sales appears as income in the period of recognition and reappears as write-down in the period of default. The company does not escape the economic reality by recognizing the revenue early. It merely defers the recognition of the loss. In the regulatory and standard-setting response, the period surrounding the Lucent matter and the broader wave of revenue recognition enforcement actions contributed to sustained regulatory attention on revenue recognition as a locus of financial misstatement. The Commission's staff guidance on revenue recognition and the subsequent movement toward more comprehensive revenue recognition standards reflected a recognition that the point of sale is where the greatest pressure to distort financial statements concentrates. The specific defect at issue in the vendor financing loop, the recognition of revenue where collectability depends on the seller's own financing of a non-creditworthy buyer, is addressed directly by the collectability criterion. And the Lucent record stands as documentation of what occurs when that criterion is not rigorously applied. The findings are the findings. Revenue was recognized when it should not have been. Receivables were carried above their collectible value, and the loop that produced the reported growth was the same loop that, upon reversing, produced the losses. The mechanism is sufficient to explain the outcome.